Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we're gonna take a deep dive into the fundamental analysis and evaluation of Visa. So, as you're used from us at this point, we're gonna go over our four valuation steps, which is basically what's in the news, what are the fundamentals, what are the important ratios, and finally, this is also the value that you're going to get. We're going to leave you with a valuation of Visa, which is going to be your head start for your own due diligence and valuations. But before we go any further, if you like the value that we give you in this video, please consider subscribing and liking the video. We will post regular stock valuations and we'll keep you posted on the progress of our web app as well. And of course, you'll then be the first one to know when our web app launches. So, Kirill, let's get into it. What's in the news?
Yeah, let's get the ball rolling, yeah? Basically, big news. Not really big, but something which Visa, MasterCard, and this kind of companies usually get is DOJ, Department of Justice, filed an antitrust lawsuit against Visa. And this is something what caused the stock also to drop last week pretty significantly. But if we check what happened, what's most important part is pretty much the Department of Justice says that Visa is a monopoly apparently. Not talking about MasterCard, not talking about any other payment processor, but Visa is a monopoly. And the reason for that is, as you can see here on their official website, is that because of the fact that the company processes more than 60% of the debit transactions, and the fact that the company is making over 7 billions in fees from the debit transaction, DOJ thinks it's a monopoly and something has to be done with it. One of also the aspects and the reasons why the lawsuit was filed is because that the company is also doing certain strategies in order to maintain certain merchants in its network, such as, for example, reducing the fees if they signed exclusive contracts with Visa, which, let me check, probably any other payment processors like MasterCard or Discover also do that. Of course, makes more sense. But today is one of the reasons why we thought it would be quite good to dive into Visa and dive into the world of payment processing in a little bit as well, and see and answer the question, what's the actual worth of Visa as a company, right? And would this lawsuit actually cause any harm to the company or to the industry in general? That's pretty much something about that. So shall we dive into the Visa as a company
Yeah,
itself? Yeah.
let's go into the first segment, which is going to be, the fundamentals of the company. All right. So before we went into this video, we checked the annual statement as we regularly do, just to check what is there or what are their strategies, what are the growth prospects. So we found the strategy pretty clearly, and what we can see is that they are really focusing on P2P or peer-to-peer networks for B2B clients, and they're also stating that they really want to enhance their B2B services for in general as well. So that was something interesting to find here, and then we can also just quickly check what their revenue is made out of, just so we have a bit more of a clear picture when we go into it later. So here we see that the majority of their revenue actually comes from data processing, which is actually quite interesting to see. Then it's followed by services, international transactions, and then some other, you know, expenditures or these revenue sources from them. If you want, you can pause the video here and you can read into them yourself. So, Kirill, are you comfortable to go into the fundamentals of Visa?
I would also just before we do that, I would also just provide a little bit of a more thorough overview of what Visa as a company, because for my previous employer, I was actually working quite tightly with Visa and MasterCard. And I think it would be also good to highlight what are the products, let's say, in their ecosystem, right? So what Visa does is not only, let's say, the debit and credit networks, right, and allowing other merchants or businesses or banks to rely on these ecosystem and its networks, right? But we also, for example, do the services such as tap to phone. So meaning is, for example, when you are a merchant and you have, instead of you buying a payment terminal, you can just use your phone and have an app on it so that other users can, or let's say your customers, they can just come in and just tap their phone and use it as a terminal. So for example, some of these solutions that are nice to have and they're making the life of merchants easier. So that's one, for example, probably some of the revenue sources that we have shown here. That probably could be the potential revenue stream, for instance. But yeah, if we go further into the fundamentals, as you say, right, it's very interesting to also show that once the lawsuit has been announced, the company was $288 per share, and it went down to 268, 269. It was quite a bit of an impact, but we will also see, and when we also, for example, continue a discussion about other competitors, for example, in the face of MasterCard, Discover, and any other local ones globally, you would see that this lawsuit actually has quite not that many merits, to be honest. But yeah, let's continue further, I would say. Shall we?
Yes, let's do it. All right, so what we can see here is basically green checks across the board. So they have revenue growth in the past 5 years, and actually quite decent one, 9.5%. So, everything considered as quite good. Their net income has been growing significantly as well, on the average of 17%, which is also a really good thing to see, right? Because it means that they are making their business more efficient.
Yes.
Their cash flow has been growing, also really good to see. Probably ties in with the net income growth. Then we can also see that their long-term debt is covered by their free cash flow as well, which is again really good to see. So basically, this means if they would need to pay off their debts right now because they would need to get out of any trouble, for example, then they would be able to do so. Their share buybacks are positive, good to see, and they're actually at a quite decent pace. So 1.9%. It's quite steady. And their dividend has been growing as well. So this is also really nice. Normally, I wouldn't mind dividends. I'm quite indifferent about it, but it's good to see that they are really trying to, appeal to the shareholders with buying back their shares, increasing the value that way, so that when the pool gets smaller, just the price of the stock will increase as well. And then same with the dividends. So not that the stock will get higher, but it's a way of a different way of appealing to shareholders, giving them a bit more liquidity along the ride. So really good things to see overall.
Yeah, I fully agree, and also what's good to see about the company, we can clearly see it from the margins, right? So having 76% of gross margins and 66 operating margins, that's very great to see. And the return investment capital is of 30% is also quite nice. One of the reasons, of course, is because this is a highly concentrated industry, right? Payment processing, debit credit card processing. You only have MasterCard, you only have Visa. Let's say if we're talking about globally, if you are talking about local competition, of course, for example, you would have UPI in China, you would have something in Europe and stuff like that. But what you also know for sure, 100%, like no matter where you go, to what kind of shop, to what kind of business, you can always pay there with Visa and MasterCard. This is something like a Coca-Cola globally, let's say. Impossible not to find it, which is always a good thing for a business, or especially for being a shareholder of such a company. If they have great pricing power, they can continuously grow their revenue, their net income, so both top line and bottom line, right, while maintaining the dominance. That's great. Super happy about it, honestly.
All right, let's dive deeper into the numbers here. So we can just see already some consistent growth, what we already discussed. So gross profit increasing, net earnings increasing. Everything is looking on the right side.
Yeah, and also it's good to see, at least as far as we can tell, the debt is quite low. So for example, the interest expense of $500 million in comparison to 25.5 billion of revenue. That's very nice. It's marginal. So the risks of going bankrupt or something like that is quite low. So for example, long-term debt, as you can see, is 19 billion. If we check, for example, their pre-tax income, in about a year, with a couple of months, they can pay out their whole long-term debt easy. That's very good. That's very nice.
Exactly. So let's move into the key ratios.
Yeah.
So here we can see something really interesting, and that's that their selling and general expenses, they are really quite low. So we are looking for companies that are generally not trying to have a lot of selling and general expense, meaning that they are able to sell their products or services as they are. So the lower this metric is, the better. And normally we're looking around 20%. And here we can see it in 2017, it was 12%, or at least 13. And now we're down to 9.8. So this is what you can see, what the power of a brand does, because so many people either already have Visa as a merchant, or it's just something that you need to accept because all your customers have Visa cards. So this is really good to see. Like, they don't need to sell their products. Even though their revenue is increasing, they are decreasing their selling and general expense ratio, which is probably not really nice for the marketing department, but it's nice for the shareholders.
I think also on top of it, we're talking about the network effect, right? So the more, let's say, users are there in the network, consumers, the more merchants there would be as well. The people who would be accepting Visa as a through the payment processing part of things from Visa, right? So that's good all the way. But we can also, for example, compare it to companies like Uber, right? So what we did before, they tried to get as much market share as possible, create a huge network of both restaurants, delivery agents, and the consumers, of course. And many people use Uber for taxi rides, but also for order of your food, right? Then also the question would be, I would say, why would you start going after Visa if they have more or less similar situation, right? So you got Visa, you got MasterCard, you got some other payment processors. Why don't you go after Uber? Why don't you go after any other these kind of network based companies? So very interesting, and it also again calls for the is there actual merit for this case? I still have a question mark for that. It's just the nature of business, and it's really hard to say that it's a monopoly. Everyone can start making their own payment processor, globally, locally, doesn't matter. Sure, no problem. But then the consumer would be thinking like, okay, is it actually worth for me jumping on another payment processor or not? So, and as you can see, especially with selling in general expense, doesn't look like it. They don't even need to market themselves. People are just going there themselves.
Exactly. And again, really good to see. So positives all around.
Yep.
Yeah, I can see here. So the revenue growth. Yep. What we discussed, 9.5%. It's been slowing down a bit. Do we know why? Do you have an idea why they slowed down on the revenue expansion? Or
I think this is one of the graphs that I would like to show you guys as well, is just the market share by payment processor. This one is a little bit outdated, but the layout is more or less similar. So this one is based on the US market, but Visa is already the biggest one out there. So it has already 61% of the market share, in a ballpark of that, right? And then the second biggest one is MasterCard, who is actively eating the market share away from Visa, of course, because they're the runner-up company, right? And then you have American Express and Discover. So what it means is that how hard or how easy would it be for already the biggest company in the industry to grow even further at the rates of, let's say, 10%, 20%, and so on and so forth. I would say it would be rather complicated, right? So it's a similar question that you would be asking to a company like like Coca-Cola. Coca-Cola is already everywhere, so you don't even need to grow anything apart from, let's say, just based on the inflation rates, for example, per year. That would be already more than enough because you're the biggest one in the world.
Exactly. Yeah, I was really interesting, like where Visa was not accepted yet, in which countries. I'm considering that, or at least what I'm seeing is that the list is not that extensive, so they don't really have other growth possibilities into the international market. So it is something to consider. So you have a really good company. Their core business is not going to change, but you have to understand that it's not going to grow as much.
Yeah, and also I would say the good thing is about it is that they also try to come up for other solutions, right? So not only just exploiting their debit and credit networks, but we also try, for example, with tap-to-phone solutions for merchants and stuff like that, tokenization, yada, yada, yada. Don't have to go into the details, but we are trying to grow it. Of course, it will be way harder, But then it also calls for another question, like, okay, if it would be a monopoly company, why don't they grow double digits every year, even now with 60% market share? Another question mark. To me, it doesn't make sense either so far.
All right, let's continue.
Yeah.
So another one that I saw was, of course, the shares outstanding change. So we see that they have quite an aggressive share buyback policy, and it seems that yeah, it's working. They have been slowing down it quite a bit. It's not as aggressive anymore, but they still do it consistently, which is really good to see. Also, they have not been growing their dividend as much as they used.
15% on average is still quite nice. Of course,
True,
last
yeah.
year is 6%, not good as it was before, right? But still good sign, right? It's all in green. I would
That's
be
true.
happy, about it. It's still up above inflation rate, so to me it's
That's correct.
green signs,
True. All right. Well, and then the only thing that lasts for us to do is the
Yeah.
valuation. So with the valuation, if you have been watching us, you know what we're gonna do. But if you're a first time watcher, we're gonna also explain what we're doing and why we're doing it. So first thing that you can manipulate in our web app is the free cash flow starting point. So normally we take the box for last year, and this will give you a decent starting point of course, the free cash flow. But for example, in situations where it might be negative free cash flow, you might want to alter it. So that's why we're giving you the option to display the free cash flow as you want. Then the projected period is for how long you would like to hold the stock, or for how long you think the company might survive. So basically, and also how adaptive the industry is and how quick things develop. So for example, for tech, we mostly do it between 2 and 5 years because things are changing so rapidly and there are new companies popping up left and right. But for this company, I would say 10 to 15 years is quite stable. We have seen the network that they have. They're really a big payment service provider, so chances are very slim that they're going to go out of business. I mean, everyone's using them. So if everyone decides tomorrow to switch to Amex or to MasterCard, yeah, then shifts might happen, but
Yeah.
the chance of that happening are pretty low.
Yeah.
Then for the discount rate, we normally keep this as 10%, but you can do whatever you would like. So if you would like to increase or decrease this number, then you feel free to do so. The estimated growth rate, we have a couple of options for this. We can either use the average growth rate. So for this is now 3 years, but on the max we see that they have been growing their cash flow for 15%, let's say, and 9.5%. And we can also go to Yahoo Finance, and if you go to the analyze tab, you will see the growth estimates as analyzed by the analysts, and they say that for the next 5 years per year, it's going to grow by 12.6%. So, and that, as you can see, that would be right in the center of revenue growth and free cash flow growth. So we can just put that. We can do 12.6%.
Yeah.
And for the projected PE ratio, we can use the PE ratio. Or we mostly use the average PE ratio.
Yeah, around 34, 35, right? On
Exactly.
average for the past 8 years, yeah.
Exactly. And yeah, for the required rate of return, as per usual, if you're buying an index fund, you are considering, or at least you would like to have between 7 to 10% returns. That's what the market has been returning historically to the S&P 500. But because you're stock picking, you have a bit more higher risk. So we bump this up to either 11 or 12%. But you can, of course, adjust this to your own liking. So if you want to have like only good deals with like really high growth perspectives, or at least you want to have really high returns and you only want to find those undervalued companies, so that might gonna give you this high return, then you can adjust these. And then for the margin of safety, this really depends on your own knowledge of the market, of the industry, of the company. So in this case, I think Kirill, you are a quite long time investor, so we can keep this at maybe like 10 to 15%. But of course, if you don't know anything about the payment industry, you want to get in and you want to see like, okay, how much should I pay for it with my limited knowledge, then you can always bump this up.
Exactly.
And then we press the analyze button, and what we see is a valuation that's actually quite close to the current price of the company. And this might indicate a overvaluation, right? But it's not as dramatic
Yeah, a couple of percent, let's say, if we're talking about the average one, of course, which is the combination of all of the underlying formulas. And then, for example, if you would be using our tool, then you would be able to see which and every single one of them means, with all the formulas and the description of the variables, which is also very good. But for example, if you're gonna remove some of the outliers, which is quite big, right? So the NPV formula of 570 makes sense because a great cash flow, and we're talking about a very long period of time. And then Ben Graham's formula, yeah, it's probably gonna be around 200, 220, 240 ballpark, which is, yeah, the question is, would you be willing to pay a little bit of a premium for the biggest company in the payment processing industry? For me, the answer is yes. Again, not a financial advice. Please do your due diligence. Or also something what we're saying every time, as many times as possible. But I would say it would also be really hard to find an alternative which is as big, as dominant, and as valuable in terms of the potential for the growth and keeping its own positions at the moment, apart from Visa. You got MasterCard, but it's also probably quite overvalued, or also something we can check maybe in the upcoming videos. But you can see that the whole payment processing industry is a little bit expensive. Maybe also something what we're going to be checking in the American Express video soon. So stay tuned for that, that's for sure.
All right. I think with that, we covered everything we want to cover. So basically, in a nutshell, good company has a great network, one of the biggest players, which might limit their future growth. But for now, it's around fair value. And if you want to pay a premium for such a big company, then you can do so based on our assumptions. But of course, do your own diligence. And with that said, thank you, Kirill, for being here, and thank you for watching. Please make sure to follow us on social media so that you know, or at least that you're the first one to know when our web app launches. And then I wish you a nice day. We're also interested in what their revenue was.
I did not know. I did not know that. Oh, fuck's sake. Shall we? From where?